Hello friends, this is Michael Harris from Price Action Lab. Let's talk briefly about trend following and managed futures. Disclaimer, there is no investment advice in this video. What we see here is the performance of the SG Trend Index from 2000. This is the index of 10 CTAs with the largest AUM that are open to new investment. Since 2000 until the end of last week, the annualized return is 6.1%, the drawdown is 23%, Sharp is 0.47, and MAR, the annualized return divided by the maximum drawdown, is 0.27. Last year, 2022, Trend CTAs had their best performance in 22 years, 27.35%. This was due to rare events. For example, the pandemic, followed by a war in Europe and a supply shock that sent commodity prices higher, and then the commodities reversed. The trend followers profited on the way up and way down, and they had very good returns for last year. Now we have to remember that the SG Trend Index, which is compiled by Société Générale, is an sample, and usually CTAs have high dispersion in returns. Some CTAs may make a very high return during a year. Some other CTAs may lose money or have low return, but this has been the performance of the ensemble. And this is the index that some of the new managed futures ETFs may follow, may track. Okay, let's move to the next slide. Since 2000, on a total return basis, SG Trend Index is up to 95%. The buy and hold of SPY ETF is 325%, but momentum, 12-month momentum in SPY ETF, that means buying when price is above the 12-month moving average and selling when it falls below, it's at 352%. This means that momentum has outperformed both buy and hold and the CTAs, the trend CTAs, trend followers, since 2000, but buy and hold and of course has a high drawdown, and the momentum and trend followers have better risk-adjusted returns. Now in the next slide, this is since 2007. I have added the performance of the 60/40 portfolio in SPY and AGG ETFs, the aggregate bond. As you see here, the SG Trend Index is up 25%, but the 60/40 portfolio is up 171%. Momentum is at 179%, and buy and hold is at 291%. This means that the 60/40 portfolio and momentum made about a half the buy and hold on a total return basis, and trend made about a third of that, or let's say buy and hold made 3.5% higher returns than the trend index. Let's go back and see why. from 2009 to 2019 there was a lost decade in trend following and managed futures. Basically the ensemble had a flat performance, the return was zero, and only after 2019 performance picked up, and then in 2022, due to the rare events mentioned, the CTAs made high returns. So it's highly likely that we may see another lost decade or lost 5 years or 7 years in the CTAs, in the CTA performance and trend following, because these rare events that contribute to performance, to high performance, may not occur again soon. So if we look at the last chart, what is good then adding managed futures performance in a portfolio? It's only good in the sense of buying expensive beta, low beta. It can provide high risk-adjusted returns to a portfolio, but total return will be less, maybe half. And for investors who are looking for pullbacks to add to positions like in 2009 and 2020, it doesn't add any value, it's expensive and reduces returns. So it depends on the risk aversion profile. For most buy and hold, passive crowd, passive indexing investors who believe that the market, the US market, is on a long-term uptrend due to wealth creation and dominance in tech and other areas, this managed future story is more of a hype than actual value. For others who are risk averse and they cannot live with drawdowns, so maybe trend following can add some value. We will talk about this in future videos. Thank you for listening and have a nice day.